Should you get an ARM or an adjustable rate mortgage instead of a fixed rate mortgage? This video is going to cover exactly that. What's up? My name is Ali Garced, or Ali the Agent, on all social media. You can shoot me a message whenever you want on Instagram. I'm pretty much always on there. And I do respond to every message as long as you're not terribly annoying or trying to sell me on something. But this video is going to cover exactly why it might benefit you more to go with an ARM instead of a fixed rate mortgage, and why I am putting my money where my mouth is and I myself am getting a 5/5 ARM on my next personal residence property. First, I want to explain what the heck an ARM even is. It's an adjustable rate mortgage, meaning that the interest rate is adjusted. Now, depending on the type, the name of the product, so like a 3/1 ARM, a 5/1 ARM, 7/1 ARM, 5/5 ARM, whatever ARM, that indicates how long your rate is at a fixed rate. And then the second number is how many times it adjusts, how many years it adjusts after that. So let me explain that further. A 3/1 ARM means that you're going to have a fixed rate for the first 3 years, and then it's going to adjust every 1 year after that. 3/1. 5/1 ARM, have a fixed rate for 5 years. It adjusts every 1 year after that. In my case, what I'm getting is a 5/5 ARM. So I'm going to have the same interest rate for 5 years, and I'm locking in, now, whenever. And then it's only going to adjust every 5 years after that. So as you can tell, the higher the number, the safer it is for the borrower. And on the same note, the higher the number, the more risky it is for the lender or the bank. A lot of people, especially first-time borrowers, first-time home buyers or first-time investors, they usually just go with the fixed rate mortgage. I mean, it's more steady for sure. Is it financially better? Not always. And it's all because we don't know what's going to happen in the future as far as the interest rates go. But if you're at a time of high interest rates, and I'm defining high as like 7%, if you're listening to this video and it's 9% right now, that's a going interest rate, say 12%, 14%. If we're in that type of environment, you might want to look at an ARM or adjustable rate mortgage. What are those interest rates going for? Because they're not the same. In my case right now, there's a 1% difference between the two. So if I were to go with a fixed rate mortgage, it's 1% higher than if I were to go with my 5/5 ARM product. So why people sometimes go to ARMs at the time of high interest rates is because it's going to be adjusted. They're not going to be forcing themselves to be stuck with that fixed rate mortgage for the full 15, 20, 30 years. Instead, they know that in 3 years or in 5 years or in 7, 10, whatever, in a couple of years, it's going to be readjusted back to the market rate, whatever that rate may be. So you are taking a chance. That is the risk. So if you're listening to this right now and the interest rates are high, take a look. The ARMs might be lower. So that's a win right there. And if you think that the interest rates are going to be lower in 3 years, 5 years, 7 years, it might be worth looking into an ARM and getting an ARM. Especially for investors, if you want to start cash flowing right away, that's a great way without having to buy down points, which you still can do with an ARM, but usually without having to buy down points. If the ARM is lower than the fixed rate mortgage, then you might as well go with an ARM and start cash flowing more right away, and then saving that money or maybe investing that money into something else. So by the time you have to refinance, should you even choose to refinance, you can just throw that all into principal or whatever it is. You have options. And that's the thing with ARMs. If you have exit strategies, multiple, like more than one, then an ARM might be the way to go. These are the reasons why I personally am getting an ARM on my next property, which is going to be a personal residence. Number one is because right now the interest rates for an ARM are lower than the going fixed rate. Number two, I have known exit strategies. My first exit strategy is to pay off the entire loan within the next 5 years. That's my goal. I've done it before. I've actually paid off one of my properties in 4 months, which originally had a balance of $121,000. So I know that I can do it. So before my 5/5 ARM comes up and I would most likely have to refinance, I plan on paying that bad boy off. My other exit strategy is in case I cannot pay off that property, something happens, I have to use that capital somewhere else for, say, an emergency, or I choose to just save that capital and instead reinvest it somewhere else, on another property, on a syndication, on buying a business, whatever it is. Then my fallback or exit strategy number two is to refinance. Now, that is taking a risk because I have no idea. No one has any idea what the interest rates are going to be in 5 years. So what's my third exit strategy is not even really an exit, it's just keeping the product. A 5-5 ARM means in 5 years, my interest rate is going to be adjusted, but typically there's a cap. So talk to the lender. And if you need a good connection to a lender, please let me know, I'll connect you. But talk to your lender and say, hey, what is the most amount that my interest rate might go up or might go down? As of right now, if interest rates are say 6% and the market rate in 3 years, 5 years, 10 years, whatever is 12%, you might not be going from 6% to 12. You might be capped at maybe 3% higher or 4% higher, whatever it is, talk to the lender. So if you can still afford it, and going from, the 6% to the 9% before you even get the loan, run the numbers. What are the rents going to be like? What's my income going to be like? Is that 9% going to break me? If it is, then don't get the product. Another exit strategy is if you are military, you might heavily want to consider an ARM if you do not want to become a landlord. You just got orders, you're PCSing to Tampa, you're PCSing to San Diego, whatever it is. I can connect you with a real estate agent that knows about this shit. Seriously, send me a text. I'm more than happy to connect you. But so say you just got orders and you know that you want to purchase, but you really don't want to be a landlord. As soon as you finish your time at San Diego, wherever it is that you're PCSing to, you know that you want to sell that property. You don't want to be a landlord. You don't want to deal with tenants, and you know that about yourself. Then in that case, an ARM might be perfect for you, especially if you know that you're going to be there for 3 years or 5 years or no more than that. You might want to get a 5-1 ARM or a 7-1 ARM because you know that you can have that low interest rate fixed for that period of time, and you know that you're then going to sell that property. As opposed to if fixed rates are higher right now, you don't have to be stuck in a higher interest rate. So if you're military and you know that you do not want to be a landlord, you do not want to keep the property, you want to just own it for the time that you're there and that's it, look into an ARM. And another big reason as to why I'm getting an ARM is because the lenders that I'm talking to do not have a prepayment penalty. Like I said before, I plan on paying this entire mortgage off in 5 years or hopefully less, and I'm not going to be penalized for that. I'm not going to have to pay them extra for paying off the loan faster. A lot of lenders don't charge prepayment penalties, but always ask. If you're looking to be connected to a good quality real estate agent or lender, shoot me a text. I'm more than happy to start a group chat. Shoot me a message on Instagram. I respond there all the time. And if you're curious as to how I paid off one of my properties in 4 months and how I plan on paying off this next property in 5 years, you're going to want to watch this video here. See you in the next one.